Welcome to Fintech Fridays.
Oh yeah!
A weekly podcast brought to you by the National Crowdfunding and Fintech Association of Canada and partners. Covering all things fintech, blockchain, P2P, AI, and alternative finance.
Hello everyone, my name's Craig Asano, the founder and CEO of NCFA Canada, the National Crowdfunding and Fintech Association of Canada, welcoming you to Season 4, Episode 64 of Fintech Fridays. It's a weekly podcast brought to you by NCFA Partners, where we sit down with the incredible people in the fintech and funding community, talk about their journeys, their projects, innovations, milestones, as well as trends and developments, all from their perspective. So today we have a fantastic guest with us. I'd like to introduce Shael Weinreb. He's the founder and CEO of the Home Equity Partners, otherwise known as HEQ for Home Equity. He's responsible for managing all aspects of the business with a particular focus on corporate strategy, capital partners, and value creation. He brings 15 years of real estate experience, and he's held executive roles at Republic Developments and Starlight Developments. He's also served as the president and COO, or the operating officer, so he's got operating experience at Freed Developments. He holds a law degree from Queen's University Faculty of Law and a BA from Guelph. So Shael, thanks so much for joining us today.
Thank you so much for having me. I'm really happy to be here.
I always love the bios. I always wonder how it makes the founders feel. So welcome to the show. We're looking forward to this. I've dabbled in real estate myself, believe it or not, over the years. So I'm particularly interested in the conversation and learning more about everything we're going to go through today. So just to kick things off, for anyone who hasn't actually heard of HEQ or the Home Equity Partners, their first time, what does HEQ do, and what is the problem they're solving for Canadian homeowners?
Yeah, so the Home Equity Partners is really designed to offer an alternative solution for homeowners to access equity in their home. So up until recently, there's been a handful of ways, and most of those products are debt-related products. So if somebody has built up a sufficient amount of equity in their home through paying down their mortgage and generally paying down their mortgage and sort of being a responsible homeowner, the products, to the extent that they want to pull equity out of their house, they've really been limited to things like a HELOC, a refi where they're upping their mortgage. In some cases, if you're 55 or older, a reverse mortgage, and in some extreme cases, really selling your home. So in some cases, people might have a $150,000 problem, but because they can't access credit from an institution, they have to sell a $2 million asset to deal with a $150,000 problem. And that can be really unfortunate. So the Home Equity Partners is really a model that is replicated in some ways based on the success that it has had in the US. It's been around probably for the better part of 20 years in the United States. And when I look at it and how sort of, popularized it's become over the last number of years and how many families it's been able to help across the US, I saw a lot of parallels between what was happening there and what was happening here. And we decided to be able to offer the same product to Canadian homeowners the same way that US homeowners have had the benefit over, like I say, the last almost quarter of a century. And so it's really designed to provide a different way for homeowners to think about how they access built up equity in their home.
Fantastic. It's another one of these stories where Canada's years, if not decades, behind some of these innovations. So thank you for, bringing these solutions to market. Absolutely. So one of the things we do on the Fintech Fridays podcast, we always dig into a little bit about the founder's story, a bit more on, the background. So if you don't mind, just for the audience, sharing a bit about your background and what led you to, launching the Home Equity Partners. What's been that first year experience? Have you crossed any milestones in preparing for the podcast? I came across a press release that talked about $11 million in shared equity value now. So that's a good segue into, a little bit more about you, Shael, and, really as a founder, and what that experience in the first year has been like, and really right up to today in terms of a timeline.
Yeah, no, I think it's a great question. Listen, I mean, I think I knew from a relatively early age that I wanted to become, sort of an entrepreneur, or in the business world. And as I got older, I started to sort of go back and forth between law and really becoming a lawyer based on some legal shows that I watched. And I sort of watched a lot of the action in the courtrooms on television with shows like Suits and other, LA Law and so on. And I thought there was something really cool about being able to be a litigation lawyer and be able to go into a courtroom and formulate an argument for a client that was, in need of some representation and to really help sort of fight the fight, I guess you could say. And so I had a bit of an identity crisis. I knew I wanted to go to university, so I ended up at Guelph, like you said. I graduated with an honors degree in criminal justice and public policy. And I said, even if I don't want to become a lawyer for the rest of my life, I always figured that a law degree would be a really great education and would serve me well in the corporate world, assuming that I wanted to try my hand at entrepreneurship. So I went to Queen's Law, like you said, graduated, worked on Bay Street for a number of years, and then left private practice on Bay Street. And I transitioned into in-house corporate kind of roles, like in-house legal roles, for a couple different companies. So that, and these were real estate development companies. So I could learn about real estate and I could continue on as a practicing lawyer. So I would provide legal advice to those companies. And then ultimately, when I was working for a company called Freed Developments, like you said, a few years into my employment there, I was promoted from in-house counsel to chief operating officer, and then eventually promoted again to president and chief operating officer. And that was really the first time in my career, and that probably goes back to 2019, I would say. That was really the first time in my career where I could start really making business decisions. And really, even though I had a boss that I was accountable to, I certainly had a lot of influence. And I really liked the action that came along with making, important decisions and living with those outcomes and coming up with strategies to sort of arrive at the most successful outcomes that we thought were possible. And with that taste as president and CEO of the company, I knew for sure that I wanted to see what I was capable of doing, in my own sort of business. And so I stuck around in real estate development for the next number of years. And while I was working for Republic Developments, like you said, and Starlight, somewhere in the back of my mind, I started sort of experimenting in my head with different ideas. I was looking around the world at, maybe some inspiration for what other countries were doing in different areas. And then ultimately, it was really based on personal circumstance. And I've actually said this before, but my father, just in 30 seconds, my father was very sort of equity rich, cash poor. And so he had a house in the GTA. House was worth about $2 million. He had a $100,000 mortgage on the property. So he had about a $1.9 million equity position in his home. He went to the Bank of Nova Scotia, where he had banked for over 40 years, and said, listen, I'm 80 years old. I have a pretty substantial equity position at my home. I'm not liquid. I don't really have, other assets at this time. And I really need $100,000 to deal with a problem. And the bank said no. They took it to their underwriting team and they said no. And at 80 years old, when you've only banked at one institution your entire life, if they shut you out, you have no idea where to go. Sort of, to me, the alternative lending universe is very complicated. There's some good ones, there's some bad ones, there's some predatory lenders, there's some loan to own lenders, but there's some really great ones as well. But I think for the average person who doesn't really know much about the industry, it could become a really scary place. And what I really discovered was that, through some of my own research, I figured that there had to be a better way. And what I mean by that is not just kind of take out like a second mortgage with a high coupon and then have a 1-year term attached to it and have to figure out a way to pay it back. And so I looked to the United States. Like I said, I found this concept of a home equity sharing program. And I said to myself, my dad can't be the only one in the GTA that's going through this, because of restrictive lending practices that a lot of these institutions have in place. There's got to be a lot of otherwise qualified people who are being shut out every day by the only lender that they've ever known. And so we want to be able to provide sort of a soft landing for them with our product, and not only provide a soft landing with more sort of flexible criteria, but a very different way of thinking about how you take out home equity, and in some ways a much more friendly way, instead of taking out loans at high interest rates. So that was the inspiration behind the company. It was really, I think the flick, the switch went off in my head through my dad's experience. And then the motivation was to try and help other people like my father, really across this country eventually, to help people, be able to deal with their financial problems and have some disposable income that they can live on.
I think that's the greatest motivational, impetus, we'll say, for launching the business. I mean, it resonated with me. I think everyone, well, my father's 84 too, so every situation's a little bit unique, but I absolutely, get it. But, the fact that it's been in the US for so long and it hasn't been here, and it's brand new, we'll call it sort of like a new, financial product. It's a new financial category in some way. Have you run into a lot of challenges and pushback from, some of the folks that you're working with, or what sort of lessons and insights you might have for other founders? Because we do have founders, we have investors listening to the podcast that, might be worth sharing at this point in terms of, what you're trying to do, because I think it's important for everybody.
Yeah, so it's very interesting. Like, what I've learned is starting a business from scratch is hard enough, not alone to start a completely new category that's really never existed before. And this is a category that plays to people's emotions, because in many cases their home is their biggest asset, and there's lots of financial disclosure that has to take place before you can qualify for the product. Similar to like a mortgage application, but you're giving, your debts, your assets, there's a level of trust there. And so for a lot of people, when it comes to home and finances, people are particularly passionate and, paranoid, rightfully so. And dealing with a group like ours, the Home Equity Partners, who's been around for a year with a brand new product that nobody's ever heard of, it's an obstacle. It's certainly an obstacle, and there is pushback. And what we often get is that we are compared to reverse mortgages. And why are we compared to reverse mortgages? Because with our product, there are no interest payments for up to 10 years. And I think, one of the feature of the reverse mortgage is no interest payments. So once people hear no interest payments, automatically they revert back to reverse mortgages. Our products couldn't be any more different, other than the fact that there is no interest payment. But in our sense, there really is no interest payment. In their case, there are no cash payments every month, meaning that there is interest on a reverse mortgage, but it simply accrues behind the scenes. So the interest meter is theoretically running 365, days a year, 24 hours a day, but you're just generally not out of pocket every month where you're forking over the $400 a month interest payment. Instead, it's just being sort of, like I say, accruing and tabulated at the end of every year. So if you take out $100,000 at the end of the year, you do have a $7,000 interest bill, but you're just not out of pocket on it every month, and then it compounds every year. So that's been something that we've really had to kind of focus on, is distinguishing between our product and a reverse mortgage, because sometimes they get lumped in together. And then just education on our product is really the most important thing for us right now, is making sure people understand why this product makes sense and get them to believe in it the way that we believe in it.
Well, this is a perfect segue into, let's try to break down that education here, what's known as a HESA, the Home Equity Sharing Agreement. For those listening for the first time, what are the mechanics, like from a homeowner's perspective? How does it actually work?
Yeah, so we, high level, the maximum investment that we'll make in any one house is $500,000. So the upper limit is $500,000. The minimum investment from a dollar perspective is $50,000. So that's number one. $500,000 on the high end, $50,000 on the low end. Number two, we invest anywhere between 5 to 17.5% of the value of one's home. 5 to 17.5%. So if the home, as an example, is worth $1 million, gets appraised at $1 million, we will cut a check to the homeowner for anywhere between $50,000 all the way up to $175,000. So $50,000 being 5% of the value of one's home, all the way up to $175,000, or 17.5% of the value of the home, and anywhere in between. So those are kind of like our goalposts, 5% to 17.5%. So let's say, hypothetically, you have a house that's $1 million, okay? And you came to me and you said, you know what, I want a HESA, which is a home equity sharing agreement. We would look at your file, we would look at your application, and let's say, hypothetically, you qualified for 10% of the value of your home based on the appraised value, which is $100,000. 10% of $1 million is $100,000. So fine. So you would get the $100,000. There'd be an application fee of 3.9% that we would take off the top. That would come off as a disbursement on closing. And you, as the homeowner, would be responsible for the legals and title insurance and the appraisal fee. So there's a handful of disbursements on closing. The net goes to you. It's a one-time fee of 3.9%. There's no renewals. You have the money for 10 years. It's an upfront payment. We don't sort of enforce another payment along the way. There's no disposition fee. It's just a one-time fee to us for the decade that you have the money for. Now, going back to what I was saying, so you take out a 10% position or $100,000. The idea is, how do you arrive at the profit split? Meaning, moving forward, to the extent that your house rises in value, how much does the home equity partners receive, and how much does the homeowner receive, or you receive? What we do is we apply a 4 multiplier or a 4 multiple to whatever the percentage amount is that we invest. So in other words, if we invest or take a 10% position, we would be entitled to 40% in any change in value moving forward during the duration of our relationship. So because you took 10% of the value of the home, we simply multiply that 10 by 4. We arrive at 40%. So that means 40% for us, 60% for you. Had you said to me, Shael, I need 5% of the value of my home at $1 million, which is $50,000, we would take 20% of any future change in value. You, as the homeowner, would retain 80%. So 5 times 4. So whether it's 5 times 4, 6 times 4, 7 times 4, 8 times 4, 9 times 4, and so on, all the way up to 17.5% times 4. So whatever that number is, that really determines the profit split. And so that's how you come up with that particular part of the program. The other thing that I should mention is that we discount the value of the house. So if the house gets appraised by $1 million, we discount the value of the house by 5% on day one, meaning that allows us to arrive at what's called the starting value. So if your appraised house comes at $1 million, for our internal purposes, the real starting value is $950,000. So we'll give you the $100,000 based on the $1 million, and the 10% is based on the $1 million. But to establish the starting line, we discount it by 5%, so it's $950,000. And we do that for a number of reasons. The most important of which is that what we can't have happen is you come to us for the $100,000, we give you the $100,000, the house is appraised at $1 million. 9 months later, you call me up, you say, you know what, Shael, I want to pay you back the $100,000. We reappraise your house in 9 months. In all likelihood, it's still $1 million, and therefore you get the $100,000 for free for 9 months. That can't be the way that we run our business. That's not fair to our investors. We can't be in business that way. So our product is really designed to be for homeowners that really want to hold on to the product for probably 3 years and longer. If it's kind of like a quick in and a quick out, and you really want to be in it for like 8 to 12 months, based on that 5% discount, it probably doesn't make sense. It becomes really expensive. But if this is something that you're using to kind of continue to remain in your home for the next 5 to 7 years before you downsize, or you have a mortgage and now your mortgage payments are significantly higher because of the mortgage renewal kind of wave that has occurred over the last number of months and moving forward. This gives you an opportunity to create like an extra fund effectively to make up for that shortfall so that your cash flow isn't impacted for renovations, and you want to live in your home, but you want to, renovate or do some updates to your home. So there's lots of use cases. One of the cases that we've seen is even a divorce where, husband and wife break up. Husband wants to buy wife out of the property, but doesn't have the funds to be able to do that. So the husband came to us for, a six-figure number to be able to buy his wife out of the home. And now they'd be able to keep the family home, which is great. And, sort of the wife moves on. And in the absence of having our product, they would have had to sell the home. And that wasn't what he wanted to do. He wanted to sort of continue to remain there. Especially with kids, it can become challenging and not having to sort of uproot them. So we could be a great solution for that. So lots of different use cases where our product could be applicable. But I think, just to repeat myself, 5 to 17.5%, minimum $50,000 investment, upper limit $500,000. Whatever the percentage amount is, we multiply it by 4 to arrive at what our share is versus the homeowner share. And then we simply discount the starting value by 5% or the appraised value by 5%. Those are really the key kind of mechanics to the program.
That settlement period, though, you mentioned with a couple of the use cases, I don't know if it was the divorce, but it may not make sense if it's within, say, 3-year or 5-year. You're looking more long term. That settlement period, is it not fixed or agreed, or it's flexible based on the use case?
Yeah, no. Listen, I mean, there's no handcuffs to the program. You can exit at any time you want. You can call me tomorrow. Like, you can take the investment today and call me tomorrow. What we're trying to discourage people from doing is taking out money for the short term because of that 5% discount. Like I say, if you can find that money elsewhere at 5%, you're probably better off that way, to be 100% honest with you. But the other sort of part to the program is we will actually participate in a loss with you. So how does that happen? So going back to the $1 million example, there's 2 situations really that we will participate in a loss. One, there's a 3-year blackout period. So for the first 3 years of the program, we will not participate in a loss with you. We are going to hold you to that $1 million number. So even in year 2, if you sell your house for $830,000 after year 2, we're still going to hold you down to that million. We're going to hold you to that $1 million number. So you're responsible for that $1 million number for the first 3 years. After 3 years, we will start participating in a loss with you. So how does that work? You have to sell your property. You can't buy us out at a loss. So in other words, if in year 5, we enter into a massive recession, housing prices have plummeted, your house has now dropped from $1 million to $600,000, you can't be opportunistic, call us up and say, you know what? I have a bunch of money on hand. The house is now, plummeted in value. I want to buy you out at a loss. You have to crystallize that loss by selling your home and effectively standing by that with us, not just by buying us out. The second way in which we'll participate in a loss is if the full 10 years, you've been with us for the full 10 years of the program, and your house is worth less in 10 years than it was on day 1. So those are the 2 ways that we really participate in a loss. So 3 years has to expire from the commencement date of the program, and then you have to sell your house to crystallize that loss with us, or you have to wait the full 10 years. But we will participate in a loss. So, even in my dad's example, my dad, he sold his house in 2022 at the height of the market. Had he taken out a reverse mortgage at that time to stay in the home, effectively what would have happened over the last 4 years is that the reverse mortgage would have eroded his equity in the house because, as you know, interest accrues. So that's really eating away at the existing equity that you have. And then he's also experienced market depreciation over the last 4 years. So that same house that was worth 1.9 and change could easily be worth 1.7 now. So he'd be down $200,000 on market depreciation, and he would also be down, tens of thousands of dollars in interest, if not at sort of like maybe the $100,000 mark. So he would have experienced substantial loss. On the flip side, with our product, had he gone into a HESA with us and he sold his house after year 3 like he did, and he experienced a loss, we would have participated in that loss with him. Mm-hmm. So as painful as the depreciation was, he wouldn't have had the added kicker of, $100,000 interest bill. Because with us, there is no interest. We simply win when you win as the homeowner. We make no money if the homeowner doesn't make money. So we're completely aligned. Unlike lenders that are not aligned. All they really care about, obviously, is making sure that they get paid back their principal loan and they get their interest every month. So my dad would have been much further ahead with a program like ours than a reverse mortgage.
Yeah, for sure. They're only interested in making that payment. You might get one free missed payment. Otherwise, your phone's going to be going off the hook. But
Right.
I can already envision we're going to need a follow-up to go through the spreadsheets to go through. I think if you can talk to the differences between some of the options, I think that would be beneficial for someone who's been introduced to it for the first time and sort of looking at their use case to seeing where it might fit, which product in the market might fit. So HELOCs versus the reverse mortgage, which you kind of touched upon. Where do you see from your experience dealing with homeowners today and how your product compares with the options? What are the fundamental difference from that homeowner's perspective? I'd be just curious. Is that an easy thing to summarize? Yeah.
Yeah, sure. I mean, when you look at the reverse mortgage, there's a couple things that really stand out. One, you have to be 55 and older. So that's number one. So there's no age restrictions with our product. Number two, their loan to values are generally much more conservative than ours. We are prepared to go up to 75% loan to value, whereas I think at the absolute maximum, a reverse mortgage will go up to 59% loan to value. And they do that from like sort of an actuarial perspective because they never want to be in a position where effectively the house runs out of equity, right? So if you live up until a certain age, and if the interest meter keeps running, theoretically, they could put themselves in a position where, the interest has exceeded the amount of equity in the property. Mm-hmm. So they're very sure not to do that. So our loan to values are generally much higher, so people can qualify for more money with our product than you can with a reverse mortgage. And like I said, we're aligned with the homeowner where, like I said, it's very much about profit participation instead of focusing on loan and interest. The other thing with a reverse mortgage too is that if you have an existing first mortgage, they will never go in second position. So if you have an existing first mortgage with an RBC or TD of the world, they are going to insist to pay out your existing first mortgage. Mm-hmm. And what could that do? That could trigger, a prepayment penalty. That could trigger a much higher interest rate than the coupon that the homeowner currently has with, their day-to-day lender. So they will never go in second position. So you have to be prepared to take out money from them to pay out your first mortgage, which could, like I say, could trigger additional fees and a higher interest rate. As far as traditional products go, it really comes down to cash flow and it really comes down to your appetite for risk. I mean, if you have a lot of disposable income and you can afford the monthly payments associated with a loan, that's fine. There's an opportunity for that. I'm not suggesting that we're taking over the entire home equity market and we're like an all-in-one solution for everybody and we're far better than every other product. That's not the case. There's going to be pros and cons of every product. And so, with our product, you have to be able to stomach risk to a certain degree because if your house skyrockets in value, naturally, our product could become really expensive, right? Do we see it over the next couple of years where house prices are going to skyrocket? No, we don't. Is it important to sort of keep an eye on what's happening? I think so. But what we try to do every year with homeowners is really provide sort of like as much transparency as possible. So as a homeowner, what you're going to have is you're going to have your own portal, and we're going to tell you every year approximately what your house is worth. So if you gave us, a house at $1 million on day one, and we give you a $100,000 investment, and that helps you arrive at like sort of a profit split, we have technology that's going to say in year two that your house is maybe worth $1,020,000 now, based on comps in the neighborhood or whatever. So now your total exposure to us has gone slightly up. In year three, again, these are just approximates. We don't know definitively, but in year three, your house could be worth $1,010,000, and therefore your exposure to us has gone down. Right? It's less expensive in year three than it was in year two. So we're going to do our best to make sure that after, year 10, if you stay with us that long, there's no sticker shock. We don't want to catch anybody by surprise. We want to over communicate with homeowners to make sure that they understand along the journey exactly what their exposure is and how it all works. There's no games. There's no hidden surprises. That's not what we're doing. We're trying to run a fully transparent operation. We give homeowners, a homeowner guide at the beginning to make sure that they review everything and understand the way our policies work. So with us, you need to be able to stomach a little bit of risk if you think that your house is going to go up. But I think with a line of credit, you also have to be able to expect that there's going to be interest rate fluctuations. So right now, interest rates are relatively low, and everybody sort of has a different interest rate. Like some people have prime plus 2% or 3% or 4%, depending on kind of what status level you are at the bank. But if interest rates go up, then obviously the cost of borrowing becomes more expensive too. So there isn't a product that's perfect. I think it really depends on what your needs are. And if cash flow is something that's paramount to you, I would argue that we're a really great alternative to a loan where, it's only going to, sort of erode your cash flow even more. Whereas with us, you don't have a single payment for a decade.
That sounds like music to my ears. It's that cash flow. Well, looking at this, and that's it has been very transparent. I think that's excellent information. I mean, obviously, there's a lot of details. It comes down to the contract, comes down to the meetings, but from what you've seen with the $11 million in built up home equity sharing value at HAQ, what is like the top 2-3 use cases, and then maybe one or two, where is it not suitably aligned to a homeowner situation? If we can just, because I think that would just summarize, and this is in the conditions of the market, current real estate market over the next few years. Nobody has a crystal ball, but let's basically those are the parameters. And what do you think? Who should be coming to speak to basically HEQ, 2 or 3 use cases, and then really who should not? And I think that's sort of like an acid test, a starting point for people to determine, should we go talk to Shael?
Yeah, no, it's a great question. So I think for people that come to us, and a couple of use cases, like you said, are really people in one case, well, in more than one case, people that have accumulated a lot of debt, credit cards, CRA arrears, property tax arrears, people that are credit impaired that really sort of can't qualify for a traditional loan, even if they'd like to. But I think when you come to us and you're, and it's not, there's no shame in it. It happens to everybody, right? Like the cost of living is extremely expensive. The income tax system that we have here in this country is incredibly high, and probably some of the, the most punitive, I think, amongst various places around the world. Everything that we buy has to have HST on it. So everything that you buy is subject to 13% sales tax. And then you have property taxes. Like for the average person, you're not really putting much money in your pocket. By the time you pay for a car and a mortgage and insurance and some gasoline and some groceries, there's not a lot left over. So there's no shame in having sort of a cash flow shortage. And so if you get yourself into a position where, your credit cards are starting to get maxed out and you're starting to fall behind on, a number of payments, obviously one, your credit score goes down substantially. So your ability to borrow moving forward is impacted by that. And by coming to us, there's going to be an overall cost to the product, assuming that your house goes up, but you can't look at that in isolation. What you also have to consider is the cost savings by paying all of those things off. So we, for all our homeowners, will model effectively what the cost of our product is, and the two driving kind of levers for what our cost of our product is obviously one is time, how long you hold the product, and then two, what happens to your property over time. Those are the two main levers that's going to determine the overall cost. And we have a bunch of sensitivity analysis, 3-year, 5-year, 7-year, and 10-year terms, and then 3, 4, 5% appreciation rates, or whatever it is. And that helps you to arrive at an overall cost. So there's going to be a cost if your house goes up. But like I said, you also have to think about one, peace of mind, and two, the fact that now you don't have those 20% interest payments on your credit card anymore. And now your credit score is going to start to slowly but surely start to come up. And then maybe in a few years from now, once you can have an ability to start, borrowing again at maybe a more conventional institution, if that's what your comfort level is, then you can start to do that. So I would say it's people that are sort of, starting to fall behind financially. And then, people that are just seniors that really do want to stretch their time in their home. And, they can use our HESA money almost as like a quasi pension, where they can really live off it, because many people are retiring today without pensions. and they can really live off it. And it allows them, based on whatever fixed income they have, to supplement that with our product. And now they can comfortably, go out for dinner. They can comfortably maybe take a trip once a year to a warmer climate during the colder months. They can, more comfortably pay their mortgage if they need to. They can more comfortably maybe help their kids or grandkids with a little bit of help or financial assistance. So we're starting to see more seniors look to us and the product is like I say, a reward, in my view, for having, been able to build up that equity through sort of a lower interest rate environment for a number of years and really sort of paying down your mortgage every month. So I would say those are kind of the two use cases that I see more and more in terms of people that are really looking to us for the product. And as far as people that should potentially stay away from the product, truthfully, just people that really want to be in it for like a year or two. Like I said before, with that discount of 5% and not really knowing where real estate prices are going over the next year or two, it can become, expensive, and certainly far more expensive than taking out a 5% credit line if they can qualify for that. So I think if you're really in it for, call it a minimum of 30 to 36 months and beyond, I think we start to become very attractive. But if you're looking at it, for 8 to 12 months because you need to settle like a short-term obligation, then you want to get out in 12 months, I would encourage you to sort of look around and compare our product to other products that might be available.
Yeah, no, that's excellent. And thanks for breaking it down with the levers and, all the product details. And just, I think the use cases help because everybody feels the pinch. Like you're saying, the costs are expensive. It doesn't matter your situation. And I really like the idea that there's no shame. It's financial services like that. People, sharing their files, sharing the credit information. They worry, they fear, but the worst fears could be alleviated with some of these new products, and they're definitely worth looking at as an option. So one thing I wondered, as you're talking, are you operating nationally or just here in Ontario today?
So right now we're operating only in Ontario. I would say that our primary focus is in the GTA. We have made exceptions outside of the GTA. We're starting to look actually out west as a consideration. Nothing's been formalized yet, but there's some opportunities that are starting to percolate out west. So that's a consideration for us, but the goal is eventually to become national for sure. Like at the end of the day, there is going to be so much innovation in this space because it's gotten to a point where our lending practices are so rigid and so conservative, and it's not a bad thing in some cases. Like, when they did the stress test back in 2008, when you sort of had the whole financial crisis, and they stress test all the banks in the US versus the way that we stress test here with our deposits and whatever. Like, I think our banks back in 2008 proved to be on stable financial footing. I think what it proved in the US is that many banks were not on the stable financial footing. So I think presumably Canadian banks have been able to maintain that by being very selective with who they work with. And so there has to be a lot of innovation because there's tens of billions across the country. There's hundreds of billions, but in Ontario, there's tens of billions of dollars of people that are sitting on equity in their homes. And when they look at their bank accounts, in some cases they're on overdraft, or in some cases they're living paycheck to paycheck, or in some cases they're racking up debt or whatever have you. And as we all know, you can't, swipe your house when paying for groceries. So I'm starting to see more innovation now in the space. And I think what you're going to see is even more, because I think the days of just lending as we know it, there's a place for that. There's no question. But there's certainly a real opportunity for a lot of disruption in this space to allow homeowners different ways or alternative scenarios to really take advantage of the equity that they built up in their house. And we obviously think that we're a great way to be able to do that. But over the coming years, you're going to see a lot more innovation in the space. And I welcome it. From a personal perspective with my dad and other people that are struggling, there should be more innovation. It shouldn't just be about, lending and collecting interest. There should be a lot of different ways and some kind of interesting and smart ways for people to take money out from their home. And the US is doing it. And we're really proud, in our view, to be at sort of the, on the front lines in respect to this space. And we expect to be able to help, thousands and thousands of people across this country over the coming years.
No, I think it's fantastic. Like just touching upon this idea of innovation in a category, and from what you're seeing right on that front line, over the next 3 to 5 years, where do you see it going? And is it is it just product structuring? Is it more partnerships, more capital being provided? Is it some type of regulatory changes in the lending sector, or is it all the technology? Are we going to have an AI come in and do everything and for us? Like, what do you see? What is on your mind?
Yeah, like I think it's sort of a combination of the things that you just mentioned for sure. I don't see banks necessarily like kind of pulling back in terms of their lending practices. Like I just don't see that happening. So I think banks are going to be what they're going to be. I think it's more about sort of entrepreneurialism and people trying to get innovative in the space and really introduce new categories that are maybe being done around other parts of the world, and really using that as inspiration to bring it to Canada. And maybe ways that have just never even been thought of before. But I think there's a real opportunity for smart people who like this space and recognize that there's a real need for it to start examining areas for people to take on that, to take on sort of new initiatives to access that equity. People should have choice, and people should really have choice. And I think that's one of the great things about a free marketplace, that people should have choice. And so I'm really looking forward to seeing what's coming. I'm starting to see it already. There's a credit card that certain people can qualify for with, and I might even harm my business by saying this, but regardless, I think there's a credit card now that people can qualify for people that are 55 and older, where it's a prepaid sort of credit card for like $100,000 or something like that. And you can use it when you go out and you can buy things on this credit card. And naturally you just draw down on the balance as you go. But the interesting component to it is that they register a mortgage against your property as security for that credit card. And so as security for that credit card, because there's a mortgage, the interest rate comes down substantially. So you still pay interest, but instead of paying 20%, you're now paying 7%, because the credit card company has a mortgage on your property, so that if you default or it doesn't get paid, theoretically they have the rights and remedies that any mortgage holder would have. But now there's like a new credit card that you can take out, and like I said, instead of 20%, you're now only paying 6%. So it functions like a credit card. So it's interesting. There's other things that I'm starting to hear about. So I'm really excited to see what happens in this space, because I think Canadians are deserving of as much choice as possible, and let them decide what's best for them.
Absolutely. It's really based on need, and it's going to drive that entrepreneurial innovation, like you're talking about. From your founder's perspective, and we're getting here to the nitty-gritties part of the podcast, I'd say, because we've heard a lot. I think it's fantastic. But from your perspective, what does success look like for HEQ? Maybe 1 or 3 years from now, from what you've experienced in 1 year, some great milestones, being on that front line. So where do you see success? How do you define it for HEQ in the future?
Honestly, I just define it as being able to help people. Like I'm not looking at it as in terms of like dollars and cents. I'm looking at it as an ability to scale and really to become integrated into the fabric of home, home equity choices. Like right now, we're sort of like on the outside looking in. We're certainly not part of the mainstream right now, but ultimately, I think all we're looking for is to be considered as, as an alternative to some of the other products out there. So we want to be in the discussion. And I think we're working like hell to be part of the discussion. And so, without a massive marketing budget and a massive team, we really have to get creative in terms of how we get the word out there as best as possible. And so that to me is really success, that in, 2-3 years from now, somebody says, oh, a HESA, I've heard of that. Or, oh, the home equity partners, I've heard of them. They seem to be doing really good work. Or I went to their website and I saw 7 testimonials from homeowners who really explained why the product was particularly helpful to them and how we solved, some of their problems. That to me is really what success looks like.
Yeah, fantastic. And we'll, at NCFA here, we'll do our best to, play a small part in educating folks and maybe driving some traffic to those that have a real need. So you're doing great, great work. So I guess this brings us to the part of the podcast where we just call it rapid fire questions. Rapid fire questions. So we're not looking for long answers. We're talking one or two words here. So I think the idea is just to kind of catch you off guard a little bit with some of these questions and see how you
Sure.
respond. So you ready for those?
Absolutely.
Okay,
Bring it on.
so I've got them written down here. So what's one belief that you have about money or home ownership that you think people would disagree with?
Um, that it's a right.
That's a right? What?
That it's a right. That like home. I guess what I'm trying to say is I know I'm trying to stick it to like one word or whatever or two words, but that it's a right. It's in my view, people see home ownership as this right that they should have as a citizen of this country. I think it's something that more and more is something that is not automatic. It's something that happens. It's something that happens to certain people, but you're starting to see a lot more rental communities pop up. And I think when you really look at the numbers, depending on the stock market as an example versus home ownership, in many ways, like the S&P has outperformed home prices over the last number of years. So maybe people, I guess, one, home ownership is not necessarily an automatic right. It's not something that you're entitled to. It's something that you have to work towards. And then number two is, people I think sometimes are under this mistaken belief that if I buy a house and pay down my mortgage, that by the time I retire, I'm going to be okay. And then I can always use my house as like a piggy bank. In some cases, there might be better investment opportunities. You might be better off renting and, putting your money elsewhere, like owning a home and maintaining the home, and with all the expenses and insurance and property taxes and headaches, it's not for everybody. So I think before you really think about getting into home, you got to make sure it's right for you.
It's a scary truth. Going to keep people in homes, but okay, that was more than two.
Sorry, that was a bit longer than you would have wanted. I apologize. I guess.
So move it. What's something that you learned in your first year building HEQ that you did not expect to happen?
Honestly, I didn't expect resistance in any way. I thought investors would gravitate to it immediately, and once we announced it, I thought homeowners would be lining up around the corner for this product. But as I've learned, it doesn't really happen that way.
It's well, anything new, any change seems to be a barrier, and so it requires education is absolutely critical. So good answer. So what's a decision that you've made as a founder that turned out to be better than you thought?
I honestly I was scared of the pressure a little bit of having to be, of having to grow something from scratch and really be primarily responsible for introducing this new category in the home equity space. But what I discovered is I actually welcome the pressure. I really do. I welcome the pressure. I welcome the challenge, and I welcome the chance every day to wake up and really try to bring this product to as many people as possible. And, are there setbacks along the way? Absolutely. But do I enjoy and am I welcoming the pressure and the challenge more than I thought I would? Absolutely. So that's been a really positive experience that I didn't really necessarily expect. But overall, it's been a really positive experience.
Fantastic. Last rapid fire question. What's a piece of advice that you'd give to someone who feels house rich but cash constrained?
Right. But there's options. And I think if you look deep enough, and especially with this new product that we're offering, there's lots of options out there, and you don't have to feel stuck. There's a lot of different sort of ways that you can go about it. But I think it's important to speak to people. Like, doing nothing is the worst option. Staying stuck and doing nothing and feel paralyzed is the worst thing that you can do. Speak to a financial advisor, speak to your accountant, speak to friends, speak to family, spend some time on the internet, use ChatGPT or Claude or whatever the latest AI tool is. But just do nothing, I think is really doing yourself a disservice. And I think it's important that you put some effort in to try and figure out ways that you can unlock it, because you're starting to see way more options in the market. And I think there's a solution for most problems.
No, that's like head in the sand is not a solution to, a very painful product problem. I mean, the pressure that folks have with debt and rising costs. It just continues to grow, and home ownership, as you've alluded to several times, it can become not just costly but complicated. So you got to always be in market, take a look what's out there, in between sort of government doing their role, the new ventures who are creating these new categories, new products like yourself, they have their part, and the incumbent institutions, for their type of customer, they have their own way to participate. So hopefully collectively we'll all be getting through this together. But
Absolutely.
no, that's fantastic. I just wanted to as we move into the closing here, like if anyone wants to get in touch with you, Shael, how do they? Do you have an email? Like, what's the website? Can you whether they're an investor, whether they're a homeowner, or someone who just wants to talk to you about the innovation side, how do people contact you?
Yeah, I appreciate you asking that. So our website is www.theheqpartners.com. I think, we have a general email inbox, which is info@theheqpartners.com. There's a submit question component to our website, but I can be reached anytime at sweinreb@theheqpartners.com. So SWEINREB@theheqpartners.com. And, I'm around for any questions from homeowners. I'm always available to chat and just kind of walk through different scenarios and do whatever I can to help.
Yeah,
That's really my goal.
And if you don't mind, we'll make sure they'll be in the transcription and the show notes here.
Thank you.
That's fantastic. So if anyone has any questions about, home sharing equity, the HESA agreement, or what's happening in terms of these new options in market, you really got to talk to, HEQ Partners. This is Shael Weinreb. So Shael, thanks so much for joining me today, sitting down, sharing your valuable time, your knowledge, expertise. I thought it was fantastic. I learned a lot. I'm sure a lot of our listeners have too. So really appreciate your time and wish you all the best in what you're doing. Maybe we'll sit down for one of those more detailed spreadsheet, webinar versions of the nitty-gritties with the percentages and the cost structures. But I think you laid it out very, transparently, provide a lot of education, enough for people to make the decision, like, let's go talk to Shael. So that's fantastic. So for everyone else, that's going to be a wrap. If you're new to Fintech Fridays, just want to encourage you to check out some of our incredible past episodes, because I think you'll be surprised with what you find. We look forward to seeing you next Friday for another episode of Fintech Fridays. So Shael, since this will be going out tomorrow on Friday, I want to wish you a great weekend, and again, have best of luck in the coming years to come.
Thank you so much. I really appreciate it. And thank you for having me again.
You've been listening to Fintech Fridays, brought to you by NCFA and Partners. Tune in weekly for the latest Fintech Friday podcast by subscribing to this channel. The National Crowdfunding and Fintech Association of Canada is a nonprofit actively engaged with social and investment fintech sectors around the globe and provides education, research, industry stewardship, services, and networking opportunities to thousands of members and subscribers. For more information, please visit ncfacanada.org.